Hey, good morning, everybody, and welcome to this Tuesday, March 4th, 2025 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and it's a pleasure to be with you all this morning. Thanks to all of our Earnings Beats members for your patience and understanding last week. I know we missed some things in our regular schedule throughout the week as I had to travel for some medical or some family medical issues. So I appreciate your patience and understanding there. Basically, come back to what we had when I left, which is not a very good market. But we've been talking about this. This isn't anything that should be coming as a shock. Market doesn't always give us signals before it makes moves one way or the other, but this time it did. We talked about it really since the end of January. A lot of the different warning signs that have come out. We've been talking about the economic environment. We've talked about the sentiment. I mean, how long did we talk about sentiment and the fact that we kept seeing folks pouring into the options on the call side? That eventually comes back to bite the bulls, and that's really what's happening right now. As I've said before, I remain bullish long term. I still believe this is all part of a secular bull market. And for those who haven't followed me for a while, I said the same thing during the trade war in 2018. I said the same thing in 2020 during the pandemic when we were crashing. I said the same thing in 2022, right before we had that cyclical bear market, even called the cyclical bear market before it happened. Said the same thing during the 2023 correction. And I'm saying it again. Short term, I'm worried about the market. I've been worried, but long term, I'm not. I still believe that the long-term picture looks very solid, bullish, and I think we go up to all-time highs again, very likely in 2025. And I think the market will be pretty strong, actually, toward the end of the year. But again, it's hard to make these long-term forecasts because certain things have to, come true. When you make a forecast for the next week, a lot of times it's just based on a technical signal here or there. When you make long-term calls, you're kind of predicting what you're trying to predict, the unpredictable or the difficult to predict. And so one of the things that I talked about at the beginning of the year was I thought the Fed would be, this 2025 would be a year of further rate cuts. I thought the first quarter was going to be very challenging, and we're seeing it. But the rest of the year is going to depend on the Fed getting back on board and cutting interest rates, because I think what we're seeing now is the fact that the rates have remained higher than they should have, longer than they should have, and we're starting to see the economic deterioration. We saw it in the retail sales. Recently, we just saw it in consumer confidence. We saw it last month in the jobs report. We get another jobs report coming up this Friday, by the way, which is going to be really big. And I say that, but honestly, I'm not sure what news is good news. When you're worried about inflation, you don't really want a strong jobs report. If you're worried about the economy, you really don't want a weak jobs report. So there's, I guess, maybe this little pocket somewhere in the middle where maybe it's a little weaker than normal, but it's still positive. I guess that would maybe be the best scenario for right now. But I think a really hot report stokes that inflation flame. And, when you got signs of a weakening economy, but you still have inflation problems, the Fed can't attack the economic problems because it's got to remain vigilant on making sure that inflation's not a problem. And they're talking about, the Fed's been talking about inflation. So there's a lot going on that side. But then if it's too weak, then you're like, okay, Fed, what are you going to do? Because if it's really starting to accelerate, the weakness is starting to accelerate, then we're talking about the possibility of recession. And at the same time, the Fed doesn't want to cut rates, which is what you normally would do to fight that kind of economic weakness or the potential of that kind of economic weakness. So the Fed's going to be in a box either way, it seems. And I believe that inflation is not the problem. The stock market is trading as though inflation's not a problem. The bond market is trading as though inflation's not a problem. The only one that's really seemed to think that this is a big problem is the Fed. And so, unfortunately, I think it's the lack of Fed action right now and the waffling and the lack of confidence that Wall Street has in the Fed that's actually starting a lot of this selling. I think a lot of this is related to the Fed. And you can feel free to disagree, free country. Um, that's just my thoughts. I've been following the market for a long time. I look at signals below the surface. I don't just follow the S&P 500, which a lot of people do, which is why everyone's always calling it after the fact. Oh, yeah, the S&P 500 is down 10%. Yeah, it's weak. Oh, yeah, once it's down 10%, it's weak. But looking at the signs before that, you can prepare a little bit better for these weaker periods. And, I think at Earnings Beats, that's, one of our areas of expertise. And it's not just happenstance. It didn't just, come out of thin air. It's a lot of research and a lot of work that we've done over the years, a lot of, analysis of history, looking at all these different relative ratios and so forth. And I believe that enables us to do what we do. Anyhow, we're in the midst of it right now. Some might say, well, S&P is only down 5%, NASDAQ's down maybe 8%. It's not really that big a deal. Well, it kind of is, because it looked like this was what was going to happen. And now we're getting the confirmation of it. And I don't know if you looked at the VIX, but I know this morning it was up over 24, closed 23 and change yesterday. And I've said before, nothing really good happens when the volatility index is stubborn and remains in the 20s or starts to move up into the 30s. It's not when the market goes up. That is when the market gets crushed. And so we're on the verge of waking up to something big one morning. Maybe it's the jobs report this Friday, or maybe we get that kick save. I don't know. What I can tell you, though, is that there's a lot more risk in this market right now. And, you might say, well, yeah, but, the big moves back and forth, that's how you make money. Well, that's not the way I make money. I don't want to wake up to a spin on the roulette wheel, which is kind of the way I feel when the market gets really volatile. We have these big gap ups, and we have massive rallies, and then another gap down, and then, starts selling off again, and the VIX spirals higher. I don't like trying to catch every single, big move up, big move down. I like the quiet, boring action when the VIX is sitting at about 10, to be honest. I don't want to have to go to bed worrying about what we're going to wake up to in the morning. And when we get the VIX at 23, 24 and climbing, unfortunately, that's what we're just starting to feel the surface of it. And so that will bring me to where the futures are this morning. So let me just give you these real quick. They're down, not horrible yet, not quite to that point, but you started to see a little bit more impulsive selling in the market recently. Anyhow, Dow Jones down 0.25% so far this morning. S&P 500 down about 0.5%. The QQQ, which tracks the NASDAQ 100, home of a lot of those big market cap tech names and so forth, down about 0.4%. These are off the lows from earlier this morning, by the way. We were definitely down further. The IWM small cap down just over 1% this morning. And one of the themes I talked about for 2025 was I thought small caps were going to absolutely explode this year, gaining a lot, significantly outperforming the QQQ and the Spider. But one of the things I talked about that the small caps were dependent on was lower interest rates. And we needed to see the lower interest rates, not just the 3 we had at the end of 2024, but the Fed was talking about multiple interest rate cuts in 2025 and into 2026 and maybe even into 2027. And once you get inflation under control, you have that ability, or the Fed has that ability to do that. As long as you can cut rates and continue to see economic growth, but not economic growth out of control, just good economic growth, you can cut rates, use that to enable smaller banks to borrow cheaper money from the Federal Reserve or from each other. And then that would allow those smaller banks to reach out to many of their small and mid-cap companies for needs that they have to grow their business. Right now, that cost is expensive. It came down a little bit at the end of 2024, but it hasn't come down enough. And it's going to be really interesting to see what the Fed does. I think the meeting is March 18th, 19th. So we got 2 more weeks before then. We're going to have a big jobs report out on Friday. And then next week, we've got the core CPI and core PPI coming out. Of course, I focus a lot more on core CPI. But yeah, I mean, Those are a couple of catalysts maybe. But even, you know, we don't know what the Fed's going to do, even if those reports are favorable. I don't think the reports over the past few months have been bad on core CPI, yet we've seen the Fed waffle and go back to be a little bit more hawkish after essentially announcing that they were going to be more dovish back in September, October, when we started cutting rates. So I think we've got this period we got to get through, and I always like to refer to it like as a bridge. We got this bridge we got to cross from where we are now, which is a very confused market, to getting to a point where I think Wall Street has more confidence in the Fed, believes that the rate cuts are coming. And at that point, I think you see the market shift again. And I believe you'll see the small caps at that point do what I think they're going to do, which is outperform. But this is a delay, and how long does it last? And does the Fed really mess this thing up? I can't predict that. I kind of feel like we're at the mercy of the Fed. And if the Fed continues to talk about inflation and the fact that they're worried about inflation, they're just going to watch for a while. There was the chance we were going to get a cut in June, and then that kind of went away. I think the Fed needs to bring that hope to the market, or we could have a really rough period ahead. All right, let me go ahead and take a look at the action from Monday. So we got the Dow Jones Industrial Average, you can see down 650 points. That was 1.48%. Let me zero in here so you can kind of see this a little bit better. There we go. S&P 500 down more on a percentage basis, 1.75%, back down to 58.49. So we came down. I'll show you a chart on the S&P 500, but we came down to about this range. And Friday, we made a big push back to the upside, remember? Saw a lot of reversing candles, and I thought, okay, maybe we're going to get a little bit of a bounce. I did not think we were out of the woods, and I thought we were going to go back to lower lows, but I wanted to see, hey, let's get this rebound. What is the rebound made of? Do we see money rotating right back into these technology names? Do we see names like, Netflix and Meta and Tesla, the Mag 7, Microsoft? Do we see those start to pile on some pretty big gains during this rebound? And if so, that starts to give us a little bit more comfort about the type of pullback that we might be seeing. But if we see that kind of reversal and we're not getting the money rotating back into those companies, then to me, that's a signal that we're not done to the downside. And based on that reversal on Friday and what I thought was a pretty decent chance for the bulls to maybe get us back up to the 6,000 level on the S&P, maybe even a little tad above, that never materialized. And immediately we saw selling in growth versus value. We saw selling in discretionary versus staples, right back into that downward draft in the market. So I'm viewing this, beneath the surface signals, these signals as continuing to be quite bearish, short term. And trying to predict a bottom. I mean, I've thought all along that we could easily have a correction, 10%. We're halfway there with the S&P right now. Another 5%, another 300 points on the S&P, and you get back into the 55.50 range. We were up to 61.40 something, I believe was a high. I mean, that's 600 points. That's pretty close to 10%. So it wouldn't take much. And I'm telling you, when you get the VIX up in the 20s, it doesn't have to take very long either. If we continue to sell off, the fear continues to build, and especially if we get a jobs report on Friday that's either too hot or too weak. I mean, I can't even imagine if we have a negative jobs report. It's been a long time, but we came up well short for the month of January, and I think February is going to be a little dicey. I'm not going to try to predict that report. I have no idea what's going to happen with the report, but I do believe we're almost in this market right now where, any kind of news is bad news. If it's a weak report, then it's bad news about the economy. If it's a strong report, then bad news about inflation. And I think the market is in that kind of mindset right now. So anyway, that's where I see the market right now. NASDAQ, 18,350, down 500 points yesterday, 2.64%. That's a big day to the downside. And if you remember, last Friday, we got that big, not 4 days ago, but like 11 days ago, we had that big down day in consumer discretionary versus consumer staples. Remember, that was the 10th worst day on a relative basis, intraday from open to close. So not gap downs. Gap downs can be manipulation. I'm talking about pure selling all day long in the XLY and buying all day long in the XLP. The difference, the difference in the percentage drop throughout the day in the XLY versus the gain in the XLP, that disparity was about 4 percentage points between those two sectors. There have only been 9 times since 2009, since March of 2009, the end of the financial crisis. There have only been 9 other times where we've seen intraday a bigger spread than that. Money getting out of discretionary and into staples. And in those other 9 instances, 8 of them occurred during bear markets, cyclical bear markets, which are short-term bear markets. Secular bear markets are kind of like what we dealt with from 2000 to 2012. We had the dot-com bubble, kind of had a cyclical bull market, a short-term bull market, 2003 to 2007. And then we had the financial crisis related drop. But that 12-year period, the market did absolutely nothing. Go down. I mean, from where it was 2000 to where it was in 2009 at the low, we lost a lot of ground, probably 50% or more. But eventually, when you break out of that secular bear market, you're taking out the highs from 2000, 2007. So that to me means we had about a 12, 13 year secular bear market. But these things that I'm talking about have all occurred since March of 2009. So 8 of the 9 prior worst intraday days between consumer discretionary and consumer staples, 8 of them were within cyclical bear markets, and 1 was within a correction. 1 happened, I believe it was in 2023, might have been back during the 2015, 2016 period. Anyway, it was during a correction. My point is, you don't have these kinds of huge, massive distribution days and rotation days in consumer stocks during periods when the market just keeps going higher. You just don't see them. We haven't seen them. I mean, if we just turn around right now and we go back to an all-time high, it will be the first time since 2009 that we've had a day like we had 10 days ago and just shrugged it off and went back to all-time highs. So I don't believe that's what's going to happen. I believe we've got more weakness ahead. Now, we're going to have bounces from time to time. I think it might show up like an ABC kind of a pattern where we go down, VIX spikes, and then all of a sudden we reach a short-term low. We have a bounce for a few days. The VIX comes down but still remains elevated, and then we have potentially one more drop. And I could see all of this happening in March, potentially. But again, I think some of it comes back to the Fed. I think if the Fed comes back later in March and says, okay, we're seeing more signs of economic weakness, that's going to help us on the inflation front because it cools demand. And so, based on what we're seeing, we're starting to feel more comfortable about cutting rates later this year. I think if the Fed comes and says something like that in March, then I think we could see a bottom sometime in March into maybe early April. Then we'll have another earnings season. The market will start getting much more excited about the possibility of rate cuts. And so they'll overlook, even if we do have a period of not so great earnings, the market will look ahead. The market will say, oh, we've got rates cuts coming. Economy's going to improve. And any kind of sell-offs will be met by a lot of buyers. That's maybe my dream scenario. Whether or not the Fed cooperates, like I said, that's a big question mark. Anyhow, you can see it was not a good day yesterday. And if you look over at this chart right here on the S&P 500, we started the day off after really quality finish on Friday. I said, hey, this is the bull's chance. Let's see. We did actually go up in the morning. We went up yesterday morning, and then basically the selling just kicked in. And as you got later in the day, the selling got worse and worse. And then right in the last, 10 minutes or so, we got that maybe 20 minutes. We got a nice little bump to take us off the lows, but that was still a really bearish day yesterday. And now, like I said, we've got futures, which take a look, see if they're getting any better. No, actually dropping a little bit more. So, unless we get a big turnaround here in just the next, 10 minutes or so, we're probably looking at some more selling at the open and early market action. Wish I had better news, but I try to report what I see. And, there are some who think I'm perma bull. But those obviously that were folks that were not around back in 2002, where I was very bearish when we were setting all-time highs and stayed bearish all the way through the majority of that cyclical bear market that we had in 2022. And then had the big call in June of 2022 that I thought the market bottom was in. And it looked like it was until the Fed got involved. That was that, remember their meeting from Jackson Hole? I think it was like August 26th, 2022. Not that I remember numbers or anything, but pretty sure it was that day. And that was the day the Fed said, oh, we got more pain ahead. That was after the market had rallied 700 points off of the bottom call. And then they said, oh, we got more pain ahead. You know, it's like the Fed doesn't want to be left out. It's kind of like that really irritating umpire. I used to coach girls softball and travel basketball as well. And, you know, when you get an umpire or referee that wants to be part of the game rather than just call the game, that's kind of what the Fed felt like on August 26th to me. It's like, okay, just tell folks what you're seeing. You don't need to editorialize. You don't need to say more pain ahead. What are you talking about, more pain ahead? Your job isn't to forecast the stock market. So that was probably one of the things that really turned me against this Fed. I just don't like the editorializing. You got a job to do. You got a couple of pretty clear mandates. Tell us what you're seeing, what you think is going to happen. Be transparent and go home and leave us alone. And that is not what we're seeing with this Fed. So anyhow, that's why I'm worried about the Fed. And that's why I talk about the Fed, because I think it's really important that the smaller companies in the US and the mid-cap companies start to play catch up, and they need access to capital. They need cheaper funding. And we were on our way until the Fed just waffled recently. And now look at what's happening. Since they did that, small caps have been absolutely getting crushed again relative to the S&P 500. Now, recently, if you look at the last week or so, we're starting to see maybe a little bit of sunlight, if you will, shining on the small caps. And personally, I think it's because as the market sells off and we get these economic reports that don't look so great, I think it's increasing the odds that the Fed's going to get back on the wagon to cut rates again. And so I think we're seeing a little maneuvering, and we're going to keep watching it. We'll let you know. But I think there's a little maneuvering, maybe back towards small caps and away from the Mag 7. Mag 7 stocks have been getting hit hard, several of them. But I'm just starting to see like a little bit of that. And so I don't know if it's enough to start making major calls, but it's something to at least be aware of. But you can see small caps down 2.4%, mid caps 2.25%, VIX up 16%, showing a close 2278. I thought it was over 23. It must have been like right at the last minute when we got that pop in the market. I probably didn't see the VIX close, but still 2278. We're gaining 16%. And with the market showing weakness at the open, we're probably going to get a pop in that VIX. Actually, I think you can get that pre-market. So let me see the VIX right now. No, it's not showing it. Pretty sure I saw that earlier today at 24 and change. Anyhow, watch the VIX, because I think it's going to, unfortunately, I think there's a very good chance that it spikes at the open. And I'm telling you, you get a VIX up into the mid 20s. We are literally on the verge of what could be a steep drop and a quick drop. So, I thought the bulls had the opportunity on Friday to kind of reverse things, and they didn't do it, or it didn't last very long, and right back down to new lows. It just doesn't make me feel very good when I know the market's nervous and I see problems on both the inflation and the economic side, inflation being the Fed and the economy being just the reports that have been coming out. My gosh, if you're looking at any of these housing reports, just about every one of them are just absolutely horrible. And unless we see a little bit of a drop to bring mortgage rates down a little bit, I don't know. And by the way, the Fed funds rate is not mortgage rates. A lot of folks say, oh, the Fed's cutting. I've heard ads before from mortgage companies. The Fed's cutting. We're going to, big drops coming in mortgage rates. And I'm like, they're not even tied together. What? There's a lot more that goes into the 10-year Treasury yield. And that's really what you should be following if you're looking at mortgage rates. The 10-year Treasury yield, when that comes down, that tends to bring mortgage rates down. When it goes up, just the opposite. because they're longer term. Fed funds rate, we're talking about 1 month. Now, that doesn't impact a 30-year mortgage. Anyway, we'll look at that another day. So I just wanted to go over that. And then looking at the sectors yesterday, I'm going to maybe try to get that. There we go. So, just look at what is on top here. Real estate, consumer staples, healthcare, utilities, financials. The first four are defensive groups. The fifth one, financials, that's an aggressive group, but it's a value-oriented aggressive group. Dividend payers. Also, we talked about, last year, financials being the beneficiary of when rates come down, those short-term rates, because the spread widens. And that's nirvana for in particular banks. When you get the spread widening between what they have to pay to borrow and then what they also, deposits, however they're borrowing. And when you get that coming down, and then you've got the loan side of it, which is the, mortgages. Not all banks have mortgages, but any kind of loans. When rates are going up, that's the spread. So they're earning income at a higher rate, and they're paying out for deposits. They're paying out interest at lower rates. And so you get this widening. And so, I saw a report yesterday, or an article I was reading, talking about the earnings growth in Q1 and the fact that the S&P 500 gained 17% year over year, Q4 versus Q4 of the prior year. And the market going in, analysts were only expecting 11%. That happens all the time. Analysts, you got to understand the conflict of interest. Again, that's something else I'm not going to get into today. But I'd pay little attention to analysts that come on to CNBC or whatever, because Wall Street, there's just a massive conflict of interest. They're buying stocks for themselves. They're acting as market makers, so doing the opposite of what everyone else is doing. And then they got their little analyst folks that go on to the media outlets telling us what to buy and sell. I'm like, wait a minute. So you're telling us to buy these stocks, but when we buy them, you've got your market making unit on the other side selling the stocks. And then you're also managing money. Are you telling folks to buy before you're buying for your clients? Or are you buying for your clients? And then it's like, who thought this system up? But it's a system we have. And so, unfortunately, Wall Street controls everything. They're the greedy bunch that a lot of times gets out right before the market goes down, which is why we follow those under the surface signals. All the money's been rotating into defense. It's been happening since a month ago, which is one of the reasons why we've been so cautious in the market and why we thought we might be in for a correction. And on down days, you expect that kind of ratio or that kind of relationship. You do expect on down days for defense stocks to be doing well. But even while we were trying to go to all-time highs, defensive stocks were outperforming. And that's a no-no. We don't want to see that. And so that was, again, part of the reasons that why we've been cautious and why we've thought that we could see this thing morph into a correction. And for those wondering, well, could it morph into a bear market? It could. I don't think it's going to. Again, I don't think the reports that we get are going to be horrible. I don't think that the jobs report's going to come out negative. If it does, that's going to be that could really spook the market. But I don't think that's going to happen. As far as the inflation reports, I think they might remain, 0.3. Maybe we see 0.4. But we've seen that before when rates are coming or when inflation's coming down. We have this little bit of a bump and then, things start to calm back down again. And so, I think that the possibility is there that we could get some disappointing news. But I think for the most part, the big part of what the Fed was trying to do with inflation is behind them. It's been done. Right? The inflation rate is in half of where it was at the peak. And the Fed said all along that it was going to be tough. The last leg, getting down to 2%, was going to be difficult. They said that before they waffled and went back to a hawkish stance. And then it did exactly what they thought it would do. And then they went back to a hawkish stance anyway. Look at the bottom of this list. So outside of energy and materials, which I consider to be more neutral, sectors. You've got technology, discretionary, industrials, and communication services. So you got mostly the aggressive areas of the market. I mean, if you look at something like, let's let's go into technology here. And here is software. You can see it went down 1.24%, but let's look over the last week. Software down 3.38%, renewable energy. Look at semiconductors down 9%. But let's go back a month. Now look at software. So we just went through the month of February where we saw a lot of software companies reporting. And I thought software, personally, I thought it was going to, that group was going to do really well with earnings. I mean, back at the beginning of the year, I really liked software. And then unfortunately, we started seeing software companies, even if they reported good numbers, you might see a gap up, but then big sell-offs. And so we, and then leaders like Microsoft started falling apart. And so we've got some of these key areas of growth that are not performing well, underperforming the market, and it's a drag. Think back to 2023 when the market was going up, 2024. These groups, these aggressive groups were kind of grabbing the rest of the market and carrying them to the upside. And now they're a major weight on the market. And the market's unable to go higher when you've got groups that represent large percentages of the S&P 500 struggling. And so that's where we're at right now. And like I said, with the VIX moving up, now we're going to get into what I would consider more irrational type of market behavior, especially if the VIX keeps rising. I mean, historically, and I've published an article on this. This was back at the end of 2023 in November. You can go back and check my Trading Places blog. Pretty sure it was November of 2023. I wrote an article about how the stock market performs when the VIX is at certain levels. The absolute worst by far is when the VIX is closing above 20. So yesterday closed at 22 and change, and you saw a really bad day. Well, as we keep going up, if we keep going up, you're going to see some more really bad days. So I hope the market turns around and we kind of put the bottom in to this A leg to the downside. Maybe we get a B bounce coming up. But I thought we had a really good chance on Friday and we didn't follow through. So I'm just a little concerned. And by the way, you're not seeing a whole lot of individual stock charts. To me, the big picture is what's important right now. And I'm not talking about the big picture like I talk about on the weekly market report, going out 100 years. I'm talking about top-down approach in the market. If I believe the overall indices are going to go down, it's kind of hard to get excited about stocks, individual stocks, because they're going to be fighting an uphill battle. It's kind of like being in a secular bull market and trying to short. When 70% or 75% of the companies are going up and you're trying to short, you got limited number of stocks to try to work with. And unfortunately, that's what we're in right now, but the opposite. We got the market going down. And if you're trying to play on the long side, it's got to be on the defensive area or one of the defensive areas, or you're probably fighting an uphill battle and probably not going to win at this point. So anyhow, there is the 1 month, looking at the 1 month. I mean, electronic equipment, a lot of AI stocks in the areas that you can see down here that are getting beaten up pretty bad. That's probably one of the worst areas in the market right now. And that's what happens. These stocks get bid up. Their valuations are way too high too soon. And they get beaten back up again. And when they get beaten up, it's actually a time, if you like those companies, right now you look at Palantir, which was 124, and now it's, I don't know, 80s or wherever it's at. And you think, well, I don't want to touch this thing. You didn't have a problem buying it when it was 124, but now it's 80 and you don't want to touch it because you feel so bad about the market overall and the big drops. This is the type of company, Palantir, in my opinion, where if you wanted to have 100 shares of it, maybe you buy 10 now. And if we get another big drop later this week, maybe buy another 10. And you start building your position. And if it keeps going down, you still have more capital that you're going to be getting in even cheaper and cheaper. And when the market bottoms finally and starts turning up, you're going to start to feel, the positive effects of that on the way back up. But everybody wants to try and find the exact bottom. And then when the exact bottom hits and we start rallying, everybody wants to wait until we go back down to that bottom. And unfortunately, that is just an emotional cycle that is almost impossible to win. And so, I think you just got to kind of say, hey, market's dropping. Very likely it's going to be up, at least in my opinion, very likely it's going to be back up again, all-time highs later this year, maybe even within a month or two. I don't think it'll be that quick, but I think we'll have some pains along the way. But I do think we could have a bottom within the next month. That wouldn't shock me. A 2025 bottom in the month of March would not shock me. Anyway, let's take a look at the S&P 500. I'll just give you a couple of the main. Oh, wow, it's already past 9:30. Time's flying. I got to get out of here too. Let's just take a quick look at the see what's going on in the market, and then just kind of wrap this thing up. So Dow Jones right now down 395 points. That's 0.91%. Remember when I was showing you pre-market, it was a 1/4%. Now it's 0.91. S&P down 9/10. NASDAQ down 1%. Small caps down almost 2%. Mid caps 1 3/4%. This is what I talked about as the VIX rises and the fear builds. You can have some very, very swift sell-offs. VIX now up to almost 25. This is not a good market. It's a very, very emotional market. You can see big moves in either way, in either direction. If you're chasing, you can get whipsawed back and forth. Very, very painful. It'll make you want to not ever look at the stock market again. So for me, it's more about just kind of watching. I've talked about cash being a great position during downtrends because your purchasing power is going up. Your account might not be going up, but when you do finally start buying, you're going to be buying at cheaper prices. So cash is never a bad option when you're in this kind of a market. For those of you that are new to Earnings Beats, I do just want to mention, go over to earningsbeats.com. You can sign up, 30-day free trial. We got a lot of good stuff coming in March. Great time to be a member because we'll help guide you through these next, what could be a very difficult next few weeks to a month. So you can sign up, get a free month when you sign up for our regular paid service. But we also have a free newsletter. Scroll down, make sure you sign up with that, your email address, and check that out. I think you'll enjoy that. That's just another way to get to know us a little bit better. Also, please hit that like button and subscribe to our channel. We're talking about doing more and more of these live stream events on YouTube. And if you are a subscriber, when we start these live stream, you'll get notified. So it's really important to be a subscriber and have your notifications on so that you'll know when we're doing these events. Because if we're doing them live stream on YouTube, they're going to be free. So make sure you subscribe and turn your notifications on. I think it's that little bell. I don't really follow it that closely, but anyway, if you've got your notifications on and we start a live stream, you'll be notified. So keep all that in mind. But I do appreciate all your support. And again, thanks to our members for your patience and understanding last week. I'm trying to get caught up right now with all the chart lists. I've got a couple of appointments of my own this week, so it's going to be a busy week. But I'll get caught up by the weekend in terms of all of our chart lists being updated. We'll have that seasonality report out. That's already a little bit, late. I apologize for that. Just didn't have time to get into it. I have started it though. So hopefully by tomorrow, I'll have that seasonality report out. Anyhow, everybody have a great day and happy trading.